Welcome back to One More Stock channel. Today we are launching straight into a deep dive on a really fascinating fintech player, one that kind of operates in the shadows of traditional lending.
Right.
We're talking about a company whose core business isn't, approving the best loans, but actually evaluating applications that major lenders have already said no to.
Yeah, the
Have
reject.
been tossed aside.
That's the intriguing starting point, isn't it? We are unpacking Pagaya Technologies, ticker PGY. This is a business built really on using AI to find hidden creditworthiness in pools of applicants that, well, failed the conventional screens.
And the big question we're trying to answer today, this comes straight from the analysis over the One More Money blog. How exactly does Pagaya manage to turn this pool of rejects into, well, Wall Street gold? It's a pretty compelling way to put it.
Yeah, it is. So our mission today really is to understand their asset-light setup, the strength of their AI. Is it a real moat? The crucial trade-offs they've made, using stability over maybe higher margins. And, ultimately, who is this kind of company actually built for? Which type of investor?
Okay, let's unpack this then.
All right.
Yeah. So if we look at the fundamentals, Pagaya isn't trying to be a bank. Not at all.
Yeah.
They don't want to hold that risk. Instead, they position themselves as a pure B2B AI-enabled intermediary, kind of like a sophisticated software layer.
That's a good way to think about it. Connecting the folks originating loans to the capital markets that actually fund them.
Right.
And that intermediary role, it really centers on what they call the second look ecosystem.
Second look.
Yeah. So when a partner bank or maybe a fintech lender runs an application through its usual process and rejects it, maybe just because the FICO score was a few points too low, a simple rule.
Okay.
Pagaya steps in. They take that pre-filtered rejected pool and apply their own, proprietary machine learning models to find signals the traditional system might have just missed.
So they're essentially trying to fix an inefficiency in the old way of doing things. Finding that little slice of profit that the big guys couldn't see because their systems are too rigid or maybe don't look at the same data.
Exactly right. And the genius, if you want to call it that, of their operating model is that it's highly asset light.
Right, you mentioned that.
Pagaya avoids carrying the credit risk on its own balance sheet. That's a massive differentiator. What they do earn is commission or fee income.
Okay.
And the One More Money blog notes, it's generally in the range of maybe $4 to $5 per $100 of loan volume they manage to facilitate.
So it's purely a volume and speed game for them, driven by fees.
Totally. Fee revenue is the name of the game.
But, okay, hang on. How do they convince the capital partners, the hedge funds, insurers, asset managers, to buy a basket of loans that were, literally just rejected by a bank? How do they successfully pass off that risk?
That's the key question, right? They rely on two main mechanisms that tie them directly into the capital markets. First, they're a significant issuer of asset-backed securities, or ABS.
ABS, okay.
They pool these newly underwritten loans, the ones they're AI approved, and then they sell them off as structured financial products to institutional investors. The fact that Pagaya is known as a major issuer of AI-originated ABS tells you something about their scale.
Right, it gives them legitimacy. And what's the second way?
The second mechanism is forward flow agreements. This one's a bit simpler. They basically have prearranged deals with institutional capital partners.
Oh, okay.
Who commit ahead of time to purchasing specific volumes of loans as Pagaya's system originates them, often on a rolling basis.
So that guarantees a buyer for the loans they facilitate, takes away some uncertainty.
Exactly. Guarantees the offtake.
That sounds like they managed to push pretty much 100% of the risk out the door. But I thought I saw in the analysis, the model isn't entirely zero risk for Pagaya itself. Do they keep any skin in the game?
They do, yeah. And that nuance is actually pretty important for alignment. Pagaya often holds on to a small but not insignificant equity interest in some of the assets, especially early on, maybe before the loans get bundled into those ABS deals.
Interesting.
And it acts as a critical check, both psychologically and financially. It basically ensures Pagaya's AI models have to perform. If they don't, Pagaya takes a small hit alongside its funders.
Right. Keeps them honest, builds trust with those capital partners who are taking on the bulk of the risk.
Precisely.
Which naturally brings us to that crucial comparison. Pagaya, PGY, is constantly compared to UPSTART,
Always.
two big AI fintechs, right?
Yeah.
But the One More Money blog really hammered home that they've made fundamentally different strategic choices when it comes to managing risk.
They really have, and it's quite fascinating when you dig into it. Upstart, UPST, they operate more like a hybrid model. Yes, they partner with banks, but they also originate a pretty significant amount of their own loans.
Okay.
And crucially, they often keep that credit risk on their own balance sheet. Now, that gives them the potential for much bigger margins if the loans do exceptionally well. But as we've definitely seen in the last few years, when the economy gets bumpy or interest rates shoot up,
Yeah.
they take a massive hit. Profitability, valuation, it all gets hammered because they're holding that downside risk.
So Upstart is chasing the high potential returns, the alpha, but accepting really high volatility along with it. What was Pagaya's choice then?
Pagaya chose insulation,
Yeah.
stability. They are the pure B2B intermediary we talked about. They consciously decided to prioritize stability and capital efficiency
Okay.
by basically delegating the vast majority of that credit risk to sophisticated third parties, the insurance funds, big asset managers who are arguably better equipped to hold that kind of long-term risk. Pagaya trades away the possibility of those sky-high margins.
Right.
But in return, they get a significantly more insulated asset-light structure, much less volatile.
So their focus isn't really optimizing the profit on any single loan. It's more about optimizing the throughput, the efficiency, the scalability of the whole network, the AI and the capital connection,
Exactly.
which tells you where their competitive advantage, their moat, must lie. It has to be in the intelligence, the AI, not in holding the capital.
Couldn't have said it better myself. And if we connect this to the bigger picture, the core defense for Pagaya really is data scale. The One More Money blog emphasizes they've processed just an enormous volume of applications, over $2.9 trillion worth.
$2.9 trillion. That number is, well, it's almost hard to wrap your head around. What does that kind of scale let their AI actually do?
Well, it lets the AI constantly adapt, constantly refine its models using billions and billions of data points. It allows them to incorporate non-traditional data sources, things like behavioral signals, maybe digital footprints, stuff the traditional FICO system just ignores or, frankly, can't process.
Right.
And this creates a true classic network effect.
Which is that flywheel idea,
Yeah.
right? More partners mean more applications,
Yep.
which gives them better, smarter models,
Accurate.
which in turn attracts even more lending partners and, crucially, more institutional funders who trust the output.
Absolutely. And that momentum leads directly to what the analysis called the win-win-win ecosystem.
Okay, break that down.
Sure. First win. The lending partners, the banks and fintechs, they get to monetize rejected leads they would otherwise just throw away. It's found money for them.
Makes sense.
Second win, the funding partners, the institutions buying the ABS or in the forward flow agreements, they get access to diversified AI-originated credit exposure. Often it's not correlated with their other fixed income stuff, which is valuable.
Diversification, okay.
And third win, maybe the most important from a societal view, some borrowers receive credit access they were previously denied. It actually expands the overall credit pie a bit.
Okay, that ecosystem makes sense. Let's turn to the financials, though, because this is where the rubber meets the road, right? The model seems to have started proving itself out recently, after years of investing in that AI.
Right? Burning cash.
Pagaya is finally hitting meaningful profitability.
That's right. Big milestone. They achieved $8 million in GAAP net income back in Q1 2025, which was a huge improvement year over year.
Okay.
And they followed that up with the second consecutive profitable quarter in Q2 2025. It shows they've likely hit operational leverage. The fixed costs of building that powerful AI are now being covered, and then some, by the growing fee revenue.
And this focus on capital efficiency, it seems to be getting validated by the capital markets, too, especially as they push into new areas, new verticals. The One More Money blog highlighted a couple of key expansion areas.
Yeah, that strategic diversification is really crucial. It helps prove that their AI isn't just a one-trick pony for personal loans, that it's fungible across different asset classes.
Like what?
Well, first, they successfully executed AAA-rated auto ABS deals.
Wow, AAA, that's the highest quality rating you can get.
Exactly. Being able to issue AAA-rated debt, backed by auto loans that their AI underwrote, that shows tremendous capital markets confidence. It says the big conservative investors trust the reliability and consistency of Pagaya's models, not just the volume they produce.
There's this huge validation. It means the most careful money believes their algorithms can actually predict risk correctly, even in a different sector, like secured lending. Huge.
It really is. And second, they've strategically moved into the BNPL space, buy now, pay later.
Another hot area.
Right. They issued their first bonds backed by point-of-sale loans, working with partners like Klarna, for example. This broadens their data pool even more, reduces their concentration risk, just makes the whole business much more resilient if one particular sector hits a downturn.
Okay, so the bull case looks pretty solid. Data dominance, network effects, capital markets validation, profitability kicking in, low volatility. But let's be balanced. We need to get into the trade-offs, the bear case, starting with maybe the biggest one, the capped upside.
Yeah, the capped upside by design. It's the direct consequence of that asset-light model we praised earlier. It's the flip side, because they offload nearly all the credit risk.
Right.
They inherently limit their potential profit capture compared to a direct lender who holds the loan. If an unsecured personal loan performs perfectly, pays high interest, well, the institution that bought the ABS or the loan itself reaps most of that juicy margin, not Pagaya.
So in a really strong economy, a raging bull market, investors might just skip over PGY. They'll look for a riskier play that maybe offers 5x the potential return.
Exactly. Pagaya's stability becomes less attractive when risk appetite is high. And this also ties into that critical problem of adverse selection.
Right. You mentioned they're fundamentally dealing with a reject pool. Can their AI really consistently overcome the fact that these applicants were already turned down once?
That's the multi-trillion-dollar question, isn't it? Adverse selection basically means the applicants they see are just on average intrinsically riskier. They failed the first hurdle for a reason, usually. Now, Pagaya bets their AI is good enough to find the diamonds in that rough. But if their models falter, even just a little bit, maybe because the economy shifts in an unexpected way, the losses could mount faster than expected. That residual risk they do retain or the losses their funders absorb could surprise the market.
And that could cause capital partners to get nervous and maybe pull back.
Precisely. The fact they don't internalize all the underwriting suggests they're very aware of the inherent volatility in that reject pool. They manage it by offloading it.
Okay. And then for growth investors, there's that other structural issue, the rule of 40.
Ah, yes, the tech metric benchmark.
Yeah, where your revenue growth rate plus your profit margin should ideally hit 40% or more. Signals a really robust high-growth tech business. Where does Pagaya stand?
Well, as the analysis laid out, Pagaya's current numbers, they're sitting around, say, 30% revenue growth plus roughly a 5.2% margin. So that adds up to about 35%.
So close, but not quite there.
Right. And while 35% is certainly respectable, that shortfall signals a potential structural limitation. Because their business is fee-based and asset-light, it's just inherently harder for them to generate the high margins needed to hit that 40% benchmark. They'd need explosive, almost impossible growth acceleration to make up the difference.
Which keeps those pure high-growth tech investors maybe looking elsewhere.
It tends to, yeah.
And finally, we can't ignore the risk around their partners, right? Their whole B2B model depends entirely on those relationships.
Absolutely critical.
What happens if a major funding partner or maybe a large lending bank they work with decides, hey, we've given Pagaya enough data now, we can probably build our own AI model in-house and keep the fees?
That's the competitive threat, the algorithmic arms race, essentially. If Pagaya's partners decide they can replicate the capability and internalize the profit capture, Pagaya's volume could drop off steeply.
So they constantly have to prove their AI is better, provides unique insights the partners can't get themselves, makes renewing those big agreements a constant challenge, I imagine.
It's the core challenge of their model, yes. Continuous innovation and proof of value are essential.
Okay, so let's bring this all together. The final verdict from the One More Money blog seemed pretty clear. Pagaya isn't really positioned to be a rocket ship stock.
No, probably not.
Its strength is more in that stable growth, the AI differentiation. It seems built for consistency more than explosive returns.
That sums it up well. It's a fundamentally lower variance way to get exposure to fintech and AI in lending. So who should be looking at PGY? Who's the ideal investor here?
Yeah.
Well, you should probably consider this company if you're someone who really believes AI is the future of credit underwriting, if you actually prefer lower volatility and appreciate capital discipline.
Right.
And if you're comfortable aiming for, say, mid-teens to maybe low double-digit type returns over time rather than swinging for the fences.
So it's kind of a bridge between a pure, maybe speculative AI play and a more stable capital markets-focused financial institution.
That's a great way to put it. A bridge.
What could fundamentally change that story, though? What could shift the investment case or the valuation significantly?
The One More Money blog suggested the narrative only really shifts materially if Pagaya makes one of two pretty hard choices. Either they'd have to fundamentally change that asset-light model,
Yeah.
start holding more risk on their own balance sheet to capture a higher margin per loan,
Basically.
become a bit more like Upstart,
Oh.
ironically.
Okay. Big strategic shift.
Huge. Or the other path is somehow dramatically accelerating their growth rate way beyond what anyone currently expects to actually hit and sustain that Rule of 40 benchmark purely through volume and fee growth.
Both seem like pretty heavy lifts from where they are now.
They do. So until one of those happens, you should probably expect stability, differentiation, but not necessarily an explosion in the stock price.
All right. That brings us to our final provocative thought for you, the listener, to chew on. Pagaya's risk insulation, that stability we've talked about, has been highly valued in these recent years of, macro uncertainty and high interest rates. But what happens to its valuation if interest rates were to dramatically normalize, maybe fall significantly? And what if investors suddenly start rewarding high beta, risk-on plays again, favoring firms that do take on more credit risk?
Hmm. What does that potential shift tell us about the market's long-term view of risk insulation in fintech? Is it always valued or only in certain environments? Something to think about.
Definitely something to ponder.
And just a quick reminder for everyone, this article and discussion is for educational purposes only and does not constitute investment advice. Investors should always conduct their own due diligence before making any financial decisions. We are not responsible for any investment losses incurred based on the information provided.
Thank you so much for watching. We really hope you found this deep dive valuable, a good shortcut to getting informed on Pagaya. We'd love for you to subscribe to the OneMoreStock channel so you don't miss any of our latest videos on U.S. stock investment analysis and these deep dives.
Yeah, hit that subscribe button.
And please do like this video and leave a comment below. Let us know what you think about Pagaya, about this topic. We really want to hear from you.
See you again in the next stock analysis. Bye now.